day, students. The purpose of this recording is to detail the multiple choice questions and how you should have answered in your assessment. This points to the introduction to finance, 20 marks, and your 20 questions in the MCQ you should have been provided. And I'll be detailing and going through each and every question in this video. Please be aware that the video might not appear, the questions might not appear in the same way the questions appeared when you were doing the actual assessment, given that we did scramble the questions and we did also scramble the answer options just to make sure that people weren't cheating. All right, let's go through question one. The first question asks, the Marble Foundation is contemplating the purchase of new equipment, which may potentially increase your revenues by 25%. It gives you your current sales. They're currently at 850,000. Your cost of sales is 55% of sales. If your cost of sales is 55% of your sales, then your gross profit, which is 1 minus your cost of sales, will then be 45% of your sales figure. It says your equipment is expected to last 5 years, with your tax allowance then also granted at a 20% per year. The cost of your equipment is 257,500, and your corporate tax rate that has been provided is 28%. The question asks, what is the estimated annual tax payment increase or decrease? So what we're trying to do here in the first question is only calculate what the tax increase is as a result of having purchased this new equipment. So what we're going to do is first calculate the tax, assuming that we are not purchasing the equipment. If you look at how much sales we had previously been earning, we had previously been earning sales of 850,000. Our gross profit at 45% of the 850,000 multiplied by the 28%, we were initially paying tax of 107,100 before we went and purchased the equipment. If we now went and purchased the equipment, what we're going to see is your sales are going to increase at a percentage of 25%. So you take the 850,000 sales you were making, you multiply that by 1.25, which is a 25% increase in those sales. You multiply that by 45% to get to the gross profit. But remember, SARS will now also give you a deduction for your purchase of your new equipment. You've spent 257,500, okay, and that is getting depreciated over a period of 5 years. Okay, so you've got the gross profit you need to pay tax on. You've also got the deduction relating to the wear and tear allowance you're given by SARS of the 257,500, which you've taken into account. Then you multiply both of those by 28%. The tax you're paying is 119,455. Okay, so in terms of the increase in tax, what we're going to do is you're paying the 119,455 and you were initially paying the 107,100. What your tax has increased by is 12,355 increase. Okay, moving on to the second question. It says you are evaluating a project for the Mzansi Golf Club and you estimate that the sales price is going to be 400 per unit, and your sales volume in year 1 is 1,000. In year 2, it's 1,500. In year 3, it's 1,325. The project has a 5-year useful life. Your variable costs are 225 per unit and your fixed costs are 100,000 per year. The project requires an initial investment of 165,000 in assets, which will be depreciated straight line to 0 over the 3-year project life. Your market value of these assets are expected to be 35,000 at the end of year 3. It then says your net working capital requirements at the beginning of each year will be 20% of the projected sales for the following year. So you're projecting firstly your sales, and then you're calculating what you need as working capital will be 20% of those projected sales for the following year. The question asks, what is the change in net working capital that occurs at the end of year one? Okay, so you only need year one and year two. You need the projected sales figure for year two. You also need the working capital in year one to just see what the movement or the change in that net working capital will be. First, what I do is I calculate my sales. In year one, my sales figure will be the 1,000 units multiplied by the 400 sales price per unit. In year two, it will be the 1,500 units I've been provided multiplied by the 400 sales price. In terms of your working capital requirements for year one, it will be 20% multiplied by the sales of year one, which was 400,000. So you get a net working capital of 80,000. In year two, it would be 20% multiplied by the sales, which is 120,000. My working capital goes from 80,000 required to 120,000 required. So the movement in what is required is 120,000 less the 40,000. You need 40,000 increase in working capital. The answer for question 2 will be a 40,000 Rand increase in working capital that's required. Okay, we've answered questions 1 and 2, and now we're on 3. 3 asks, what is the minimum rate of return used by an investor to bring the future cash flows to their present value? Okay, they've given you a reinvestment prime present rate. Okay, what we use as our rate of return, remember, to bring those future cash flows back to this time value at time 0, we use what is either called your weighted average cost of capital, your cost of capital, or it's referred to as your discount rate. It is not called your reinvestment or prime or present rate. It's the discount rate you'll be using. Moving on to question 4. In question 4, you've been provided with an income statement for company XYZ, and you've been provided for an income statement for 2019 period and 2020 period. Just below the income statement, you've also been provided, remember, with the CapEx for each of the years and your operating working capital or your net working capital for those 2 years. They've given you that the tax rate is 25%, and they've asked you to calculate the company's free cash flow in 2020. Okay, so we're going to use the 2020 figures, and we are expected to calculate the 2020 free cash flow. When we start with the 2020 free cash flow, we need to start with this line item here called your profit before interest and tax. So your profit before interest and tax for that period for 2020 is 960. We then multiply that by 1 minus your tax rate. Your tax rate provided was 25%. So 1 minus the tax rate will be then the 75%. And remember, you then need to add the depreciation and amortization as it is non-cash. Okay, so I've multiplied my PBIT. I got the interest, I got the tax payment, not the interest. I've excluded the interest. But then I needed to add back the depreciation and amortization. Okay. I get to a cash flow before I take into account CapEx and working capital of 1,420. Okay. Then I still need to take into consideration my CapEx. My CapEx that I've spent, they've given me for 2020 is 500. And my movement in working capital has gone from 500 to 570, which means I funded an additional -70 in that year. which means when I take into consideration the -70 and the -500, I should get to a company free cash flow in 2020 of 850. Okay, moving on to question 5. Question 5 says the selection of an appropriate discount rate for determining your NPV of a particular investment proposal does not depend on, does not. Okay, so what does it depend on? It depends on your discount rate will depend on what is your cost of capital that you're using for that period. The nature of the investment proposal. Is it a risky investment? Do you want to also take into account the risk of that investment? It will also take into consideration any alternative investment opportunities that are available. What it does not take into account is the present value of the proposal's future cash flows. So remember, you're selecting a discount rate. Your discount rate is completely separate to what you've estimated the future cash flows is. So when you're looking at the discount rate itself, you're determining what is the cost of capital, what is the nature, is it risky investment, what are the alternative investment opportunities. We come up with the discount rate, and then together from the discount rate, you then combine your present value of your future cash flows. So your discount rate does not depend on your future cash flows. That's the answer for question 5. Okay, moving on to question 6 on the left. It says, Kenny Company is considering the possibility of investing 1.4 million in a special project. This venture will return 275,000 per year for 12 years in after-tax cash flows. So they've given you your after-tax free cash flows. You have been provided with your free cash flows. And those are 275,000 for the next 12 years with an investment in this project of 1.4 million. It now asks you to calculate what is the nominal payback period. Okay, they've provided you the depreciation on the project, but remember your depreciation on the project has already been taken into account if they've provided you with the after-tax free cash flows already. So if you've already been given after-tax free cash flows, I do not need to take my depreciation into account. It's already been factored in. All I now need to calculate is my nominal payback. For your nominal payback, you're going to use the actual 275. You're not going to use the present values that the company has come up with. Okay, so how do I calculate the nominal payback? I first take the 1.4 million that is required as an investment to see how many 275,000 payments am I going to need to fund that 1.4. Okay, the answer it gives me is around 4.0909. Okay, but I just want to make sure I've calculated this correctly. So what I'm going to do with the method that I've showed you, I'm going to say 275,000 times 5. Okay, I get to a value of 1375. I have still not made my full 1.4 million in those 5 years. Okay, so in the 5 years, just accumulating the 275 per year, I managed to make 1375. In that 6th year, I only need 25,000, which is the 1.4 million less the 1375. You only need 25,000 in that 6th year. Okay. If I then take the 25,000 and multiply it by the 275,000 I've managed to make in year 6, I get to a value of 0.09. I add the 0.09 to my 5 years. I also still get to 5.0909. Okay, so if you look at my answer options here, I've been given 4, 12, 2.7. The correct answer should have been 5.1 years that you should have calculated as your nominal payback. Okay, then we're now on question 7. Question 7 says, Rooney is considering the purchase of a new machine, which costs 690,000. The machine's useful life is expected to be 6 years with no residual value. The straight line depreciation method will be used. Your net increase in your annual tax operating profit, which is just your PBIT 1 minus your tax rate, is expected to be 154,000. Rooney estimates its cost of capital to be 15%. We are required to now calculate the net present value of the investment. Okay, in the previous question, we were provided with the after-tax free cash flows. In this question, we are not provided with the after-tax free cash flows. We are provided with your PBIT 1 minus your tax rate, which is your after-tax operating profit. What you still need to do to get to the free cash flow is I still need to take into consideration what my depreciation was and add it back. I still need to take into consideration my working capital. I still need to take into consideration my CapEx. They have not provided me with working capital and CapEx. So the only thing I still need to do in this question 7 is take into account and add back the depreciation. Okay, so let's see how we calculate the depreciation. The cost of the machine, firstly, is equal to 690,000, and they've given you a useful life of 6 years. So if I go and calculate the 690,000 divided by 6 to get the depreciation per year, I should get to a depreciation figure of 115,000. Okay, it's just the 690,000 divided by 6. If my after-tax operating profit was 154,000, if I then add my 115,000 depreciation back to that calculation, because the depreciation was non-cash, my actual cash flows, which are after-tax free cash flows, are then equal to 269,000 per year. Now I can use that 269,000 that I'm making per year to then calculate what my NPV is. Okay, the NPV that you've been provided, if you look at it carefully, you've been provided a cost of capital of 6 years. So now we want to make the 269,000 for the 6 years. And how you're going to calculate that is I can calculate it as follows. I say equals NPV. My rate will be the 15%. Every year I'm making 269,000. Okay, I make it for year 1, 2, 3, 4, 5, and 6. I don't forget to multiply, to subtract the 690,000 machinery that I had spent, the cost, the initial cost, and my NPV will come to 328,025. Okay, that is taking your NPV at 15% and the 269,000 for the 6 years, not forgetting to subtract the initial amount you spent on this machine of 690,000. Another way of doing it was to use the payment formula of 269,000, and you've got 6 amounts coming through of that exact same 269,000. That's, I haven't taught you guys that way of doing it. And then you subtract the 690,000, will give you the exact same answer. But if you guys just took into account the 269,000 every year that you're making in terms of your NPV, less the 690,000, you should have come to the 328,025. Question 8 then states, what is the weighted average cost of capital for the firm? A firm's weighted average cost of capital, is it the maximum rate which the firm should require on any project it undertakes, the max rate? No, it is not the max rate. Okay, it's actually the minimum rate you should be accepting. Your max rate can even be higher. As a minimum, you want your cost of capital. Should it be the discount rate which the firm should apply to all projects it undertakes? No. Remember, even though you've calculated a company weighted average cost of capital, you still need to take into consideration that project's risks. If that project's risks are specifically much higher, you want to factor in that risk of taking that project, which is significantly higher. So it's not the discount rate that all projects should be used. It's used first as the benchmark rate that you're using. And should this project be either more risky, you apply a higher discount rate. If it's less risky, a lower discount rate. It's the required return which every project's internal rate of return must exceed. Okay, not every project. Remember, the same thing applies to question B and C. We're not looking at every single project. Okay, we need to look at which project, why is it applicable to that project on its own, not every single project. We're not applying one cost of capital to every single project. We're looking at a weighted average cost of capital and we're saying, okay, but this project specifically, how risky is this project? Okay, D says the rate of return a firm must earn on its existing assets to create value. Yes. Okay, it's the rate of return at least that you need to earn to create value for your shareholders. Okay, so the correct answer there is D. The reason why B and C are correct is you don't apply that discount rate to all projects or every single project. It's internal rate of return. Okay, question 9. The component parts of the cost of capital should be weighed by their proportion in the firms. Is it their current capital structure, their historic capital structure, their nominal capital structure? Remember, whenever you're looking at the component parts of the cost of capital, you need to weigh the debt and the equity based on what is the target capital structure of the business. So the correct answer there is target capital structure. Okay, we're now on question 10. Question 10 then states, Marlborough is considering an expansion project into another region within South Africa, but before determining the project's cash flows, they're determining what discount rate they should use. Based on the assessment and the risk of the company, they think it needs to be a current WACC plus 2. I'm going to highlight that. It needs to be the WACC that I come up with, and then I still need to add 2% to the WACC that I come up with. They've provided your debt to equity is 30%. Remember, your 30% as a percentage of your ratios, your debt is 30, and because it's 30 over 100, your equity is actually 100. So when you're working out your proportion of your debt as a portion of your value and your equity as a portion of your value, it's your 100 divided by 130 and your 30 divided by 130. So if you look at my calculation here for the weighted average cost of capital, I'm going to use for the equity 100 over the 130 firm value, okay? And the rate that they want, the equity return in terms of expectations, they're expecting 17%. Your debt holders are expecting 11.5%, but remember your 11.5% also needs to be after tax. So you multiply that by 0.72, okay? And now I've got my equity as weighted, and now I've got my debt after tax weighted. I get to a weighted average cost of capital of 14.99. I then needed to say, what is the current WACC plus 2%? Because I needed to use that as the hurdle rate. And because of this riskiness of the project, I have to add 2%. My cost, the discount rate I should now be using is now 16.99% and not 14. It's the 16.99%. Okay. Question 11. The market risk premium is 17%. Okay, just be aware there. They've provided you the risk premium, not the market return. So whenever you're doing your capital asset pricing model, you now need to take into consideration that the 17% has already subtracted, you've done your market return less your risk-free rate. So you need to factor into that calculation only the 17%. How do you calculate that? Okay, Your risk-free rate they've provided you is 6%. Your beta of your asset is 0.75. Okay, so how we do that calculation for your CAPM is then equals to the risk-free rate, which is the 6%, plus your beta of the asset is 0.75 multiplied by the 17% market risk premium. You get to a value of 18.75% as your assets expected return under your capital asset pricing model. Okay, question 12 on the left is not a calculation. It just asks your capital asset pricing theory asserts that portfolio returns are best explained by beta. Remember, as I mentioned, your capital asset pricing model firstly assumes that your market beta will be 1, and any returns that you come up with that are above 1 are more riskier than the market, and anything below 1 is less riskier than the market. But the risk that you're looking at, be careful of beta, is what is referred to as systemic risk. It's risk that cannot be diversified away. It's the risks within that business. So for that question, you were needed to be aware that your CAPM, it's looking at returns based on your systematic risk, which is your beta. Okay, we've answered question 12, now moving right along. Okay, I'm on question 13 now. On the left, it says, the ABC real estate company relies on issuing bonds, pref shares, and ordinary shares for its long-term financing. Rank in ascending order, which means 1 being the lowest, while 3 being the highest component costs when you actually are trying to raise this long-term financing. Okay, remember, it's always cheaper to raise debt in the market versus raising ordinary equities. So if we're going to rank it in ascending order with 1 being the lowest cost, we're first going to come up with bonds, then pref shares, then ordinary shares. So your correct answer there was B. Your bonds were the lowest, your pref shares came second, and your ordinary shares came third in terms of your component costs of your financing. Okay, question 14. Question 14 says, suppose your firm is considering investing in a project with the following cash flows. Okay, they give you that the required return on the project is 12%. Use the PI or the profitability index decision to evaluate this project, whether it should be accepted or rejected. Assume that the cash flows are earned at the end of the period. Okay, so what I'm going to do there is I want to calculate the present value of T1 to T6. Then I'm going to take that present value and divide it by the 92,000 to calculate the profitability index. Let's go ahead and do that for question 14. Question 14, if you look at the way I've structured the question, I bring in your NPV. Okay. Cash flows are earned at the end of the period, which makes me, I'm able to use that NPV formula. The NPV formula at 12%, which is my rate. And then I bring into consideration the cash flows from T1 to T6. 16,000, 18,500, 20,400, 32,580, 32,600, and the 35,600. I present value all those T1 to T6 cash flows back. I get to a value of 100,793. Then how do I calculate my profitability index? My profitability index is just the net present value, the 100,793, divided by the 92,000 that I had to spend upfront. My profitability index is 1.1, or you can say it's 110%. I will accept the project because it's above 100% or above 1. Okay, so your correct answer there is your profitability index is 1.1 or 110%, accept the project. Okay, question 15. ABC Engineering just bought a new machine. All of the following are examples of incremental cash flows or relevant cash flows that you need to take into account. Okay, the first one is your wear and tear. I definitely need to take the wear and tear into account because it impacts my tax payment. Number C, do I need to take into account the costs of the new machine? Of course, that needs to be taken into account. The increase in sales as a result of the machine purchase, that definitely needs to be taken into account. It's a relevant impact on your sales going forward. What I do not need to take into account, remember, is the interest expense on the loan used to purchase the machine. Your interest is then always calculated in your discount rate, which factors into your discount rate or your WACC that you're using. So I do not want to take into account in my free cash flows anything related to interest. So the correct answer there is you need to take into account all of those besides your interest expense on the purchase of the machine. Okay, moving on to question 16. Question 16 is quite similar to the other questions we've answered. We still need to now calculate an NPV. They've provided me with cash flows and they've provided me with the cost of capital of 20%. If you look at the way I've done the calculation, just go into this calc here. I said equals NPV. It's 12% that my rate that I'm using, which they provided me with. I then bring into account the cash flows from T1 to T5. T1 is 1,000, T2 1,008, T3 2,450, T4 2.8, T5 3,200. I then subtract the 8,000 investment that I had to make at T0. My PV will get to a negative 333.12. That's the correct answer for question 16. Questions 17 and 18 are not calculations, they are theory. So the question 17 and 18, if an investment project has a positive net present value, then what do we expect the IRR to tell us? The IRR will then, or your internal rate of return, will then be higher or greater than your cost of capital. Okay, whenever it's greater than your cost of capital, it tells you the same information that you've come up with a positive NPV for your project. If a firm has already paid an expense, or you're obligated to pay one in the future and you've paid it, regardless of whether a particular project is undertaken or not, you've said that cost is already incurred, then that expense will be a sunk cost. Okay, we refer to that as the sunk cost. Last two questions coming up. Questions 19 and 20. Apologies for the noise. I'm continuing with questions 19 and 20. It says, given an optimal capital structure that is 50% debt, 15% common stock, which is equity, calculate the WACC of the company given the following information. Okay, they've given you the coupon rate and the yield to maturity. Remember, your coupon rate is what you're paying, but it's based on an old rate that you've decided on. You need to be using the bond's yield to maturity of 5%. They've given you as well a dividend that you expect of 5 over your common price of 80 Rand. So you're managing to make 5 Rand for every 80 Rand that you spent on the share. And the growth rate they've provided you is 5% on the share. Okay, your corporate tax rate is 28%. So let's calculate the WACC in that case for questions 19. Question 19, firstly, I calculate my debt. My debt, I'm using remember the yield to maturity times 1 minus your tax rate. Your debt holders are expecting 3.6%. Okay, I hope everyone can see that. Okay, what are my equity shareholders expecting? My equity shareholders get a dividend of 5 Rand out of 80 Rand, which is the dividend aspect. And then they're also getting a growth rate of 5% that you take into account. So you manage to get 5 Rand out of the 80 Rand share price that you get in terms of dividends. You also manage to get growth of 5%. what is the rate that you're getting? Your equity shareholders are getting around 11.25%. If you take into consideration now the two sources of financing at 50% each, which is what they've provided you here in the case, which is your optimal capital structure, you've got 5% of your debt, 50%, sorry, not 50% of your debt, 50% of your equity. You should get to a rate of 7.425. Okay, so your 7.425 is more than 7% and less than 88%. That's the correct answer for your WACC for that question. The last question, question 20, they've given you that a company's free cash flow is 45,000 in year one and grows at a constant rate of 5% for years 2 to 5. So year one, you've managed to make the 45,000. So in year one, you'll see here, I've put the 45,000, and each year up until year 5, I keep adding the previous year at a growth of 5%, 1.05, at a growth of 1.05, at a growth of 1.05. The question then says, calculate the present value of only the terminal value. So they do not want the present value of years T1, T2, T3, T4, T5. They only want the present value of your terminal value. So you're going to, for the terminal value, remember, take the last year's cash flows, multiply that by the growth rate into its perpetuity. It says in the question that after years 5, the free cash flow grows at 3% into perpetuity. So if it grows at 3% into perpetuity, I can multiply that then by the 1.03, okay, to grow it. Your WACC less your growth rate is the 12% cost of capital you've been provided, less the free cash flow growth rate of 3%. The formula then allows you to divide your free cash flow divided by that 9% you've come up to. I get to a terminal value at year 5 of 625,985. Remember, this is the free cash flows at that point of T5. Okay. Then it says, assume the cash flows are earned at the end of the period. So I can use that 5-year period. I don't have to use a period of 4.5, which is midpoint discounting. And then I can calculate what is my NPV. How I calculate that, I take PV of your 12%, which is your cost of capital. I'm bringing it back a period of 5 years. That's 625,000 that I'm bringing back of the terminal value. So my present value of my terminal value will give me 355,201 Rand. All I've done is I've used my terminal value calculation or my terminal value formula, grown it at the perpetuity rate, divided it by 12% minus the 3% free cash flow growth rate. And then I've PV'd that amount back for 5 years at the 12%. Okay, you should get to an answer of 355,201, which is the last question, 355,201. Okay, I've gone through it quite quickly, but it's because I've already had set up the question quite nicely here in Excel, but it just goes to show you guys should have been able to complete this question within 20, these 20 questions within the 2 hours. If you guys have any questions, happy for you to email me, but that is the MCQ that you should have covered, and hoping you guys know where you've sort of went wrong. If you look at the questions, quite a lot of easy questions coming through. If I were to calculate the number of easy questions that you guys were expected to know, and those should have been, you've gotten 8 easy questions out of a potential 20 questions. Your medium questions, if I add those up, or 7 questions. So your 8 plus your 7 questions, at least 15 people should have at least scored 15 marks out of the 20 looking at the easy and the medium questions. And then the last 5 questions were difficult based on your formulas of terminal value, based on the concepts that we had, that you guys had to have learned in terms of your calculations. Thank you, guys. That's it from my side. Cheers.